Hello and welcome to Calling Monster Finance. It's September 11th, 2025. Today, the U.S. markets surged to new record highs, with the Dow Jones Industrial Average crossing the 46,000 mark for the very first time. This powerful rally unfolded against a backdrop of deeply conflicting economic signals, creating a complex but ultimately bullish narrative for investors. The day's main story was a classic case of bad news is good news. A surprisingly sharp spike in weekly jobless claims completely overshadowed a hotter-than-expected inflation report. This dynamic cemented market expectations for an imminent interest rate cut from the Federal Reserve. Coming up, we'll break down how this divergence in economic data fueled today's record-setting session, analyze key commentary from political and business leaders, and look at the sector performance that reveals the deeper story behind the headline numbers. The conviction in the markets today was unmistakable. The S&P 500 climbed 55 points to register its 24th record close of the year, while the Nasdaq Composite also set a new high, adding 157 points. But the standout was the Dow, which rallied an impressive 617 points to close above the historic 46,000 level. This bullish sentiment was not driven by signs of a booming economy. In fact, it was quite the opposite. The market's calculus was forged in the moments after 8:30 a.m. Eastern Time, when two contradictory government reports were released. Investors decisively looked past a consumer price index report that showed inflation remains persistent, and instead focused squarely on a separate release showing initial jobless claims had jumped to their highest level in nearly 4 years. The market's interpretation was immediate and clear. The significant weakness in the labor market is now seen as a more powerful catalyst for monetary policy than the lingering inflation. This solidified the belief that the Federal Reserve will be compelled to cut interest rates at its meeting next week, shifting its focus from fighting inflation to supporting employment. Adding a powerful tailwind to this optimism was the ongoing investment supercycle in artificial intelligence. While there was notable rotation within the tech sector itself, the broader narrative of AI-driven growth, recently highlighted by Oracle's massive demand forecast, continues to provide a compelling fundamental reason for investors to look beyond the immediate macroeconomic uncertainty. Ultimately, today's record-setting performance was a clear demonstration of a market prioritizing the prospect of future monetary easing and transformative technological growth over present-day economic concerns. Let's take a deeper look at the two key economic reports that define today's trading. First, the August Consumer Price Index, or CPI, came in hotter than anticipated. The headline number showed a month-over-month increase of 0.4%, above the consensus forecast of 0.3%. This pushed the year-over-year inflation rate to 2.9%, a clear sign that price pressures are not fully contained. Under normal circumstances, this kind of data would raise concerns about a more hawkish Federal Reserve. However, it was the second report, released at the exact same time, that captured the market's full attention. Initial jobless claims for the week jumped to 263,000. This figure significantly exceeded economists' estimates and marked the highest level of new unemployment filings since October of 2021. The market's reaction was immediate and unified. It interpreted the sharp rise in joblessness as a clear signal of a deteriorating labor market, a development that would force the Fed's hand. This belief was instantly reflected in the bond market, where the 10-year Treasury yield eased, closing down at 4.01%. This move indicates that bond investors are aggressively pricing in a more dovish Fed. Simultaneously, we saw a classic risk-on reaction in other assets. The CBOE Volatility Index, often called the market's fear gauge, fell sharply by over 4% to 14.71, reflecting a significant decrease in investor anxiety. The US dollar index also weakened, falling by 0.24%. As the prospect of lower U.S. interest rates makes the currency less attractive. The market's message was clear. The threat of an economic slowdown now outweighs the threat of inflation. Turning to commentary from key public figures, President Donald Trump weighed in on the economy. Following a separate, milder inflation report on Wednesday, the president had posted on Truth Social declaring no inflation and explicitly called on the Federal Reserve to lower interest rates. This stance was in direct contrast to today's hotter CPI data. Analysts note a policy contradiction, where the administration's import tariffs may contribute to the very inflation seen in the data, while its public rhetoric simultaneously demands rate cuts. However, today's powerful rally suggests the market is currently focused more on the Fed's likely reaction to the weak labor data than on this policy dynamic. Meanwhile, Elon Musk's public commentary on the X platform was focused on personal security matters rather than his business ventures. However, Musk was the subject of market news. Following Oracle's massive stock surge on Wednesday, its co-founder Larry Ellison briefly surpassed Musk as the world's richest person. This was seen by some as a symbolic shift, highlighting the immense value being created in the foundational infrastructure layer of the AI revolution. Yet, today's market action provided a sharp counterpoint to that narrative. Oracle stock gave back a significant portion of its recent gains, falling over 6%. In stark contrast, Elon Musk's Tesla was one of the day's top performers, surging more than 6%. This divergence underscores that even within powerful macro themes, daily market performance remains highly dynamic and company-specific. Now let's look at some key corporate earnings reports that provided a bottom-up view of the economy. First, the Kroger company reported its second quarter results this morning. The grocery giant posted an adjusted earnings per share of $1.04, beating the consensus estimate of $1. Kroger also raised the lower end of its full-year guidance, citing resilient consumer spending on essential goods. This positive report on consumer health offered a contrast to the negative macroeconomic signal from the national jobless claims data. Then, after the closing bell, Adobe announced its third quarter earnings. The software giant delivered a significant beat on both the top and bottom lines, with record revenue of $5.99 billion and an adjusted earnings per share of $5.31. More importantly, Adobe raised its full-year targets, crediting what it called AI product innovation. CEO Shantanu Narayan provided a key metric, announcing that AI-influenced annualized recurring revenue had surpassed $5 billion. This provides tangible evidence that Adobe is successfully monetizing its AI strategy, directly addressing recent investor concerns. The stock surged in after-hours trading and will be a key name to watch in tomorrow's session. Looking beneath the surface of the major indices, we see a story of broad strength with some important divergences. 10 of the 11 S&P 500 sectors finished in the green, confirming the rally's widespread nature. The leadership came from economically sensitive areas, with the materials sector gaining 2.14%, followed by healthcare up 1.73%, and consumer discretionary, which rose 1.70%. This broad participation is a sign of strong risk appetite. Further evidence of this was the outperformance of small-cap stocks. The Russell 2000 index, which is highly sensitive to interest rates and the domestic economy, jumped an impressive 1.83% on the increased hopes for a Fed rate cut. However, there was notable divergence within the technology space. The broader S&P 500 information technology sector was a significant laggard, gaining just 0.18%. This points to a rotation of capital. For instance, some major AI infrastructure players like NVIDIA and Broadcom finished the day down. At the same time, a mega-cap name like Apple gained 1.43%. The only sector to finish in negative territory was energy, which edged down just 0.03% as crude oil prices fell. Now, let's recap the closing numbers for today, September 11th, 2025. For the major U.S. indices, the Dow Jones Industrial Average closed at 46,108, gaining 617.08 points, or 1.36%. The S&P 500 index finished at 6,587.47, up 55.43 points, for a gain of 0.85%. The Nasdaq Composite ended the day at 22,043.07, adding 157.01 points, or 0.72%. And the Russell 2000 index closed at 2,421.53, a gain of 43.52 points, or 1.83%. Turning to key commodities, currencies, and yields. The CBOE Volatility Index fell 4.17% to 14.71. The US dollar index declined 0.24% to 97.55. The USD-JPY currency pair was down 0.13% at 147.18. The CBOE interest rate 10-year Treasury note yield fell slightly to 4.01%. Crude oil dropped 2.25% to $62.24 a barrel. Brent crude oil fell 1.84% to $66.25 a barrel. Gold was down 0.23% at $3,673.40 an ounce, and the Bitcoin USD price rose 0.6% to $114,491.22. Finally, let's look at the top 5 stocks by trading turnover today. Number 1 was the S&P 500 Index ETF, SPDR, which gained 0.83%. Number 2 was Tesla, which surged 6.04%. Number 3 was Nvidia, which finished down slightly by 0.08%. Number 4 was the Invesco QQQ Trust Nasdaq 100 ETF, which rose 0.58%. And number 5 was Oracle, which fell 6.23%. In summary, today's market action was driven by a decisive interpretation of conflicting economic data. A sharp rise in jobless claims eclipsed concerns over a hot inflation report, solidifying investor bets on a Federal Reserve rate cut and propelling the major indices to new record highs. The rally was broad-based, signaling a strong appetite for risk as the market embraced the bad news is good news paradigm. Looking ahead, a key variable to watch will be the market's reaction to Adobe's strong after-hours earnings report, which could signal a broadening of the AI investment theme into the software application layer. If you found this analysis helpful, please hit the like button, subscribe to our channel, and share this video with your friends. The content provided on this channel is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investment decisions should be made with independent due diligence and in consultation with a qualified professional. While we strive to ensure the accuracy of the information presented, we cannot guarantee its completeness or correctness. Any risks or losses resulting from the information on this channel are solely the responsibility of the individual. The views and opinions expressed in this video are those of the speakers and do not necessarily reflect the official policy or position of this channel. This content is not an offer or solicitation to buy or sell any financial instruments.